Hi class, Dr. Scott here. Let's talk chapter 2. We're going to go over and I'm going to share the screen. And this is a PowerPoint that you have access to. I'm going to abridge it a little bit. So I'm going to have a shortened version. You're going to have the full version available to you though. It's in the syllabus as well as in the McGraw-Hill Connect. But chapter 2 talks about a few things. And we're going to be talking about transactions, the ledgers, the journals, and the debits and credits of the side of things. And I'm going to preview it now. Debit means left and credit means right. And that's what you need to know. So let's keep going onward and upward. All right, financial statements. We have a series of transactions and we identify those transactions as you learned in the last chapter. Every time you get a number, it goes in two places. So we're going to identify from the source documents. We're going to analyze a transaction. We're going to figure out what it is, and we're going to do something called a journal entry. We're going to take the events, put it in a journal, and from the journal, we'll transfer to the ledgers, those T accounts, which actually, if you recall, those are T accounts right there, the income statement, the balance sheet. Those are the T's in our T accounts. We'll talk more about those. And then we will prepare and analyze what's called the trial balance, which is a listing of all the accounts with balances. So far, so good. All right, so what are source documents? We get a bill in the mail. We sell something to a customer and we have a receipt. We get paid with a check or we write a check. There are things called purchase orders that we issue to another company for things we want to buy. And there's payroll checks that go out the door, bank statements. These are all kinds of information that have financial numbers that are going to be analyzed and recorded on our books so we can prepare financial statements. So what is an account? Well, you already know about account. You know about the cash account. You know about the stockholders' equity account. You've seen accounts receivable as an account. You've probably seen accounts payable as an account. You've seen fixed assets as an account. We'll talk wage depreciation in the next chapter as an account. You see revenues as an account. You see expenses. So these are all the potential items that can increase or decrease. Let's take example cash. Cash sometimes goes up and sometimes goes down. Monies, you know, accounts payable. Sometimes they go up when you owe more money and sometimes you go down when you pay them. As opposed to receivables, they go up when you sell stuff and haven't gotten paid yet, and they go down when you collect the cash. Cash is a rough group. General ledger records all of the accounts used by the company. Okay. We've got assets accounts, and you've seen these before. The terminology, let's make sure we're on the same page. Cash. Receivables can turn to cash. Notes receivable can turn to cash. Prepaid accounts, those are cash deposits that if you get refunds, you'll get money back. Supplies, like supplies inventory. Equipment, buildings, land, these are all things you can buy and eventually sell and generate cash. So let's look at liabilities. We have the obligation to pay. We have accounts payable. We got a bill in the mail. We got to pay it eventually. Notes payable. Accrued liabilities, things that we are putting a reserve for on the book saying, we haven't got the bill yet, but we're going to owe this money. And then we have something called unearned revenue. So if you are a basketball team and all of a sudden you sell a whole bunch of tickets, you got a bunch of cash in the door, and you've got a bunch of unearned revenue. If you can't put it on the income statement as revenue, it's unearned because you haven't played any of the games. If COVID comes around and you cancel your season, that money gets paid back out. Cash came in and you had unearned revenue. Now the cash goes back and you get rid of the unearned revenue. It's no longer unearned revenue. It's a refund to the customer. Now when the games get played, unearned revenue becomes actual revenue. And we'll see how that works later on. We've got equity accounts. Common stock and dividends, and the net of revenues minus expenses, we actually know what happens there. It goes into net income, which ends up in retained earnings. We've talked about that before. So we have the expanded accounting equation. I don't know why the slides are jumping on me, but assets, liabilities, equity accounts, and equity was a stock, dividends, revenues, expenses, and that's the accounting equation. Assets equals liabilities plus equity. And then we have our chart of accounts. Notice what the chart of accounts is. It's a listing of all the names of the accounts: cash, receivables, supplies, prepaid insurance, equipment. We got liabilities, accounts payable, unearned revenue. We got equity accounts, we got revenue accounts, we got expense accounts. All of these show up on what's called the chart of accounts. It's just the name of the accounts, happens to be with an account number. Accountants like to go into account 101 and take out money and take out 201, accounts payable, paid off. Or vice versa, accounts payable can go down 106 and cash 101 can go up. And so accountants talk in numbers, even though account numbers, even though they mean names, they translate to names. So let's talk about debits and credits. What the heck is a debit and what's a credit? If you try to think of the bank credited your account, you lose. If you try to think about your credit card, you lose. The only thing debit means is left, and the meaning of credit is right. That's all. Debits equals credits. Assets equals liabilities plus equity. And we'll see in a little while, we're going to debit one account, like debit cash, it's going to go up. We're going to debit notes payable or common stock, and that's going to go up. Or unearned revenue, that's going to go up. We have debits doesn't mean up and down. It just means up and down relative to where it appears on the balance sheet and on the income statement. Again, we're going to go back to that picture that we had. Assets are on the left for a reason. Expenses are on the left for a reason. Revenue's on the right for a reason. Liabilities and equity is on the right for a reason. And we'll see that we're going to debit an asset and maybe credit revenue. We've got sales of cash of $1,000. We're going to $1,000 into cash and $1,000 into revenue. They both went up. That's a good thing. As opposed to we have a reduction of our asset of cash, and we'll see that a little later. That's going to be a credit. And we might have a reduction of our liability of accounts payable. That's going to be a debit. That's going to be lefting our accounts payable and writing our cash, and they'll both get reduced. But we'll see how that comes together. Hopefully you've been seeing in the textbook and in the exercises kind of how that works. But we will talk some more on how that works. So we go ahead and we have the accounting equation. Assets equals liabilities plus equity. And notice it says debit to increase an asset, credit to decrease an asset. So again, on this picture, the assets on the left, if you look at it here, we're going to see anytime you are going to increase an asset, that's a debit. Decrease an asset, it's a credit, it offsets it. It's not a liability, it's just a reduction of an asset. Liabilities are the opposite. We credit for increases. We have accounts payable here. We're going to go ahead and we'll be increasing it every time we credit it. And to reduce an accounts payable, you debit the accounts payable, reduce cash, you credit the cash, and that's going to reduce things. Okay? So it's going to look something like this. AP, $100, cash, $100. It's called a journal entry. Our liabilities went down 100, our assets went down 100. How about if we bought inventory? We got inventory of $1,000. We used cash to pay for it, $1,000. What happened? Our cash went down 1,000, one asset went down, another asset, inventory, went up. Common stock, we've done this before. We attract an investment. Investor invests $10,000. We're going to go ahead and debit something for 10K and credit something for 10K. Well, the investor put cash of 10K into the business and they got common stock issued of 10K. They both went up. Assets went up 10,000 and our equity went up 10,000. We're in balance. Our balance sheet stays consistent. So if you look at this picture, you can either memorize increase in assets, debit, decrease in asset, credit, increase liability, debit, decrease liability, credit, or you look at this picture. Assets, and it happens to be expenses, are increased with a debit. Liabilities, equity, and revenue are increased with a credit. The corollary is assets are decreased with a credit, and revenue is decreased with a debit. So all debit means is left, and credit means is right, and you will keep things consistent. Otherwise, you lose, and we don't want you to lose. Let's go through a couple of transactions to see how this works. Okay, the expanded accounting equation. I like using the income statement. Notice revenues, credit increase, debit for decrease. Expenses, debit for increase, credit for decrease. If you look back here, that makes sense. Revenues on the right, that's a credit balance normally. Increase it with another credit. Expenses, increase with a debit. And then they talk about something called a normal balance. Normally cash is a debit balance. Receivables, inventory, those are normally debit balances. Normally accounts payable, bonds payable, credit balances. Normally common stock, additional paid in capital, credit. Dividends is a debit balance. It reduces your equity. You need to reduce equity. How do we do that? We don't credit equity. We have to debit. We have to left our equity to reduce it. And we look at revenues. Oh, okay, we credit to increase, we debit to decrease. And expenses, we debit our expenses to increase, and we credit them to decrease. Journalizing and posting. So journal entry, we have source documents, analyze, where does this go? Then we look at journal entries, chronological listing. Everything that's going on goes with a debit and a credit, sometimes 2 or 3 debits and 1 or 2 credits, or vice versa. But at least one debit, at least one credit, and they better be equal. Cash debit, common stock credit for $30,000. Supplies debit, cash credit, $2,500. So that is a journal entry recorded in a journal. This is a general journal. We have a cash receipts journal, a sales journal, all kinds of journals. All I care about in this class is, as long as you understand general journal, chronological list of transactions, and it's always in balance, life is good. Then we post. Think of the ledger as a page. So let's go ahead and take a look at a page. We're going to have a page for cash. We have a page for accounts receivable. We have a page for inventory. Every account's going to have its own page. So when we have a cash transaction, if we get $10,000 in cash, we're going to have common stock, $10,000. That's from our journal entry, 10K, 10K. And when we did that, and we did that right up here actually, there's our cash debit 10K, common stock 10K. We go through something called a posting. And when we post a transaction, it goes into the ledger. And there we have our transaction. So didn't like the page break. All right, so we get $10,000 ending up posted, and posting goes from journals to ledgers. It's alphabetical, JKL. Journals to ledgers. We post from the journal to a ledger, which is one page. We posted the cash entry, $10,000. We posted the common stock entry, $10,000 to a page. In the old days, it literally was a page. It was a page in a book called the book's original entry. Now it's done on a computer, a little more graceful. So that's what the journal entry looks like. All journal entries, 4 things. Names of accounts, debit and credit. Dollar amounts, debit, credit. A date, and a description of what happened. If we do journal entries, all you have to write sold stuff. You can be as specific as you want or as general, but you need some kind of description so you can trace it and know what's going on. So we get the date, the title of the accounts, we have the explanation, description, and the dollar amounts, the debit and credit. T accounts, they post at 30, this is a cash account right now. What happened in cash? Well, on December 1st, we got 30,000 in cash. Oh, if we go back a second, we realize that 10,000 came from the 30,000 came from the common stock investment. But we're just looking at the cash ledger. Think of it as a page or one T account. So on that page, we debited 30 grand. We got 30 grand. And then we spent $2,500 on supplies. We spent another 26,000 on something, and we got another 4,200 for something else. Our net balance in all this is 5,700. Is our running tally. 30,000, credit 2,500 down, credit 26,000 down, debit 4,200 up. Posting from the journals into the ledgers. There's the cash page, here's the common stock page. Previous screen was the page we went through. Double entry accounting is double the fun. Every line item or every transaction has 2 minimum steps. And what are the 4 steps we do? Identify transaction and source documents, analyze, use the accounting equation, record in the journals, and then post to the ledgers. 4-step process. So here's transaction 1. Here's our cash. Here's where we recorded it. Here's where we posted it. I used to get confused between journals and ledgers, and I just had to remember it alphabetically. Journals, J becomes before L, and journals post to ledgers. We should be in good shape. We bought supplies for cash. 1 asset up, supplies, 1 asset down, cash. We debit our supplies, it's up. We credit our cash for the same money, and then we post into our ledgers. All right, so what else happened here? $7,100 supplies we bought on credit. We didn't pay cash. If we paid cash, we'd be crediting cash. But instead, we bought it on credit, $7,100. We're still going to credit accounts payable. That's the liability, and $7,100 for the asset. Notice there are no expenses yet. Even though we bought a bunch of supplies, they're over there sitting on the shelf. Haven't used them yet. And then we made some money. We sold some consulting services. We earned consulting revenue of $4,200. This time, this is going to go on the income statement, or in net and equity is the easy way to see it. You're crediting the revenue, you're debiting the cash, and they're both going up. Revenue is up, cash is up. That's why you can't think of debits as up and credits as down, because debits are up for assets and expenses, and credits are up for liabilities, equity, and revenue. Go back to our picture. Slide up. And just remember that those T accounts. Debits, debit balance for asset and expense. Credit balance, liabilities, equity, revenue. If we credit revenue or credit liabilities, they go up. If we debit them, they go down. If we debit assets and expenses, they go up. If we credit those, they go down. Then we provide consulting and rental services on credit. So we didn't get the money yet. So we did consulting, we got some rent, but they owe us the money. So we're going to record right now the money's owed and the amount of revenue generated. When they pay us, we're just going to clear receivables. What's going to happen with that? Okay, so we got cash and we reduced receivable. We got the cash, doesn't mean our sales went up. We already took care of the sales up here. We recorded $1,900 in sales. $1,600 for consulting, $300 for rent. The sales are on the books. Revenue right now is $1,900. Cash was not affected at all, but receivables was. And here we just got paid. So our receivables went down, 1 asset down, and 1 asset up. So we're not going to recognize another $1,900 in revenue here. If we did, we'd be up to $3,800 in revenue, which would be nice, but not the reality. And then we paid some accounts payable. Same idea. We affect the liabilities, we reduced by $900, and the cash we reduced by $900. We wrote the check, paid the bill. And you can see our cash T account, there's a whole bunch of transactions here. 1, 2, 3, missing 4, 8. Those are probably supplies or other activities not affecting, those are the sales on credit, and expenses credit. So then we have dividends, and dividends is reducing equity and reducing cash. We're paying out dividends to the owners, the stockholders, and they earn some money. And then we have unearned revenue, and that's a pretty important concept. All right. We received $3,000 cash in advance for providing consulting services. Let's say I was an architect, and you came, Scott, I want you to build our house. You do, you're an architect, that's what you do. Here's $10,000. Great, I say thank you. I go back home. A day later, you come back to me and say, Scott, I just got a transfer to Texas from South Carolina, and I don't need that house anymore. I have two options. I can say you can't have your money back because I started work, or maybe I didn't do any, but whatever the contract says. Chances are you're going to say, well, here's the $10,000 back. You didn't earn that. That's unearned revenue. Until I actually did work, I can't keep that money. But what happens if you contract with me today, you say, Scott, design my house. And I work my tail off for a week. And I come up with this plans of this mansion, this beautiful place. And a week from now, you come back and say, I got transferred to Texas. And I'll say, well, our contract says any work that I've done, I get paid for. And I finish your plans. So I designed the house, and here's the plans. There's $10,000 worth of plans. You can use them in Texas, or you can build them here and have somebody else buy your house. But that's money that I earned, and I'm going to move it from our unearned revenue to earned revenue on the books and do that journal entry to move it in that direction. But until I do the work, it's unearned. And it may be subject to return. Like the concert, like the airplane, you buy an airplane ticket, plane doesn't fly, you get your money back. It's unearned revenue until it flies, takes off, and hopefully safely lands, then it's revenue. Future insurance company, we have prepaids. I write a check for $2,400 for 12 months worth of insurance on December 28th, starting January 1. So that's next year's insurance, prepaid. I haven't used it up. Because if my building burns down on January 31, I've got 11 months of premium that, well, they have to pay my building, but I don't need to insure a burned down building for the next 11 months. So I use up the insurance every month as we go, and at the end of 12 months, I use up all $2,400. It's $200 a month until it's done, or maybe I cancel the policy and I'm eligible for a refund on it. And then you pay expenses for cash. You're going to debit the expense, expense is up. Credit the cash, cash is down. Remember, expenses and assets are on the same side. So my expenses went up when I debited $700 in wage expense or salary expense, and I credited cash to reduce the cash to keep me in balance. And as you recall, retained earnings immediately changes when I recognize an expense. Income is revenues less expenses. So my expense goes up, my retained earnings goes down. So my asset went down and my equity went down instantaneously when I recorded that expense. And that's the flow. So we have all these T accounts, which are all these ledger balances, and bottom line, $42.75 in cash net, $97.20 in supplies net, 0 in accounts receivable because we got paid in full, prepaid $2,400. So we're going right down. We got revenue $5,800, expenses $1,400, $1,000, and $305. The difference, and $300 in rent. The difference, the net, is going to be our net profit. And if all goes well, our assets $42,395 equals our liabilities $9,200 plus our equity $33,195. So that's going to be the flow. How do we prepare a trial balance, which is a list of all the accounts with all the dollar amounts listed down, left balances and right balances? We'll list each account. The account has zero balance, list it with a 0, it's okay. Compute the total debits, total credits, and then verify that the debits equal credits. So here's a trial balance. Cash, receivables, supplies, all these debit balance things. Payables, unearned revenue, common stock, credit. Dividends, debit. Revenue, credit. Expenses, and sure enough, 45.3 equals 45.3. We're in balance, life is good. This is called just a chart of accounts is the name of the accounts, but the trial balance includes balancing. Balances, a left set and a right set. And then from there, we actually draw a line. Right underneath dividends, that is our balance sheet. We've got assets, cash, receivable, supplies, prepaid and equipment, liabilities, accounts payable, unearned revenue, equity, common stock, and dividends. And then we have revenues, consulting and rental revenue, our income statement, and we have our expenses, $1,400, $1,000, $305 of salaries, rent, and utilities. That's how we prepare our financial statements. We got a balance sheet, income statement. And then we have to adjust the equity by the amount of our net income, because our retained earnings started, our beginning balance started at 0. We had profits less $200 in dividends. We have an ending retained earnings. So we went from balance sheet at a point in time. We talked about that in the previous lecture. Point in time on the balance sheet. Income statement is for the period of time, in this case for the year. And then we have our financial statements. You've seen this before. Income statement, statement of retained earnings, balance sheet, cash flow. The only thing we're not preparing from these statements is the cash flow statement. And that gets a discussion all of its own. But it's a pretty important statement. The balance sheet and income statement and the statement of retained earnings, which feeds the equity section of your balance sheet, is pretty tough, pretty tight, and pretty important. Here's our income statement. Revenues less expenses, net income. Statement of retained earnings is our net income. The retained earnings has our net income total here and our dividend total here, starting at 0, add net income, take away dividends. And when all is said and done, our balance sheet will reflect in retained earnings the $31.95 bottom line in the statement of retained earnings. Presentation, it gives you some tips. Dollar signs are not used in journals and ledgers, but they do appear in financial statements and other reports. The dollar sign is between the first number at the top and the last number at the bottom. You don't put dollar signs all the way down. You do a spreadsheet in Excel, top, none, bottom in a same column, different column, dollar sign top, dollar sign at bottom. When amounts are mentioned in journal, ledger, or trial balance, commas are optional. I kind of like to see them. They're a little easier to read. In the case thousands, millions, and so forth. But on a financial statement, they're always used. So it's a good habit to use them in general. Companies commonly round amounts and reports to the nearest dollar or a higher level. If Walmart was giving you financials to the nearest dollar with their sales close to $500 billion, they'd have a lot of digits. So they will say their financials are in millions or in billions, and that's okay, or some are in thousands. Debt ratio, what percentage of my balance sheet is liabilities? If I had $100 million in assets, $70 million in liabilities, how much would I have in equity? 30. And what percentage of this balance sheet is debt? 70 out of 100, 70%. What percentage is equity? 30 out of 100, 30%. So our debt or total liabilities to asset ratio is 70%. Total liabilities or total assets. And you don't need to take averages because it's just the balance sheet. It's just a point in time. If you have return on assets, return on equity, that's another word for net income divided by average assets or net income divided by average equity. Return is for a year, so you have to have beginning balance, ending balance, and divide by 2. That's the direction we hit. This is a valuation of debt risk. So what's a good number for debt? Well, the higher the debt, the higher the risk. So are you better off having 0 debt or a whole bunch of debt? Well, we're back to the answer, it depends. If you put $10 million in equity and have $90 million in debt, somebody else's money, you take a loan. We make profits, it goes to the equity holders, those 10 million. Matter of fact, you only had $1 million in debt, in equity, and $99 million in debt. All those profits go to those $1 million worth of stockholders. So you could have a lot of debt. The catch is you don't have much of a cushion. You're at high risk. If you have a couple of bad years, a negative net income or basically net loss, that's going to reduce your equity to negative, which is not bad. Not a good place to be. That is a bad thing. So some say, 60%, 70% debt is good for an industry. Some say 50. Some is we don't like any debt. Because with debt, you have to pay interest. With equity, you don't have to pay dividends. So that gives you an overview of Chapter 2. Hopefully that gave you some insight, and hopefully is a good review of what you've seen already and in an understandable way. I thank you for your time and look forward to answering any questions.